The Malaysian ringgit reflects the health of our economy. Before 1997 it was relatively stable, supporting growth. The Asian financial crisis tested Malaysia's resilience. The ringgit faced pressure and its value dropped. Businesses struggled and people worried. The crisis revealed vulnerabilities, forcing policy re-evaluation. Malaysia pegged the ringgit in September 1998 at 3.80 to the dollar to stop its freefall. Capital controls were introduced, providing domestic predictability. The peg lasted nearly 7 years. In July 2005, the ringgit was unpegged and managed against a basket of currencies. Understanding this journey shows the challenges for its recovery. After the Asian financial crisis, the ringgit recovered but faced new challenges like the 2008 global financial crisis. This crisis weakened global demand, impacting Malaysia's exports and investor confidence, leading to capital outflows and pressure on the ringgit. Around 2014 to 2016, a slump in commodity prices, especially crude and palm oil, reduced export earnings and demand for the ringgit. More recently, U.S. monetary policy, with the Federal Reserve raising interest rates to fight inflation, made dollar assets more attractive. This increased demand for the dollar, weakening currencies like the ringgit. Domestic factors such as political uncertainty and the 1MDB scandal also damaged investor sentiment and negatively impacted the ringgit. These internal issues compound external pressures on the currency. When the ringgit weakens, ordinary Malaysians feel it directly. The most obvious effect is on the price of imported goods like certain foods, electronics, and car parts. It costs more ringgit to buy these items, increasing costs for sellers, who then pass it on to consumers. Businesses relying on imported materials also feel the pinch, increasing production costs. This can lead to inflation, making it harder for small businesses to survive and potentially affecting jobs. For families, overseas education and travel become more expensive. Savings in ringgit lose international purchasing power, and foreign currency loans become heavier to repay. On the other hand, a weaker ringgit can help exporters, but this benefit can be offset if they import raw materials. The ringgit's value has seen significant fluctuations. Against the US dollar, the changes have been notable. During periods like the 2014 to 2016 commodity slump, it weakened considerably. In early 2024, it neared the 4 ringgit 80 mark against the US dollar, close to its historical low. This depreciation directly contributed to imported inflation, pushing up the general price level. Malaysians experienced higher prices for food, transport, and other essentials, eroding household purchasing power. The impact on exports is a double-edged sword. A weaker ringgit makes Malaysian goods cheaper for foreign buyers, boosting export volumes, but higher import costs can offset these benefits. A sustained weak ringgit increases the cost of servicing foreign debt, straining government finances and pressuring companies with foreign borrowings. Bank Negara Malaysia, or BNM, our central bank, plays a crucial role here. Its mandate includes maintaining monetary and financial stability. When the ringgit faces excessive volatility, BNM often intervenes. It can step into the foreign exchange market, selling foreign currency from its reserves to support the ringgit, or buying ringgit if it appreciates too quickly. These interventions are usually aimed at smoothing out sharp movements, and they're not meant to go against fundamental market trends. The goal is really to ensure orderly market conditions. Monetary policy is another key tool used by BNM. The overnight policy rate, or OPR, is its main instrument. Raising the OPR can help support the ringgit. Higher interest rates can make holding ringgit assets more attractive, which can attract capital inflows or reduce outflows. This, in turn, can increase demand for the ringgit. However, BNM has to balance this with economic growth. Raising interest rates too much or too quickly can slow down the economy, so these decisions are made carefully. They consider inflation, growth, and currency stability. The government has also taken specific measures. It has encouraged government-linked companies and government-linked investment companies, which often have significant investments and earnings abroad. The government has urged them to repatriate their foreign income, and also to convert these earnings into ringgit. This action directly increases the demand for ringgit in the market, and it helps to provide more consistent foreign currency inflows. This coordinated effort is a pragmatic step, aiming to bolster the currency using domestic resources. Beyond these immediate measures, there are longer-term strategies. Promoting domestic investment is important, as this reduces reliance on foreign capital inflows, which can be volatile. Encouraging industries to use more local content can also help, since it lessens the demand for imported components. Diversifying the economy is another key long-term goal. Reducing dependence on just a few key commodities or export markets makes Malaysia less vulnerable. Structural reforms to improve competitiveness and productivity are also vital, as these create a stronger foundation for the economy and the ringgit. After a challenging period, recent months in late 2024 and early 2025 have shown positive signs for the ringgit. We have seen the currency begin to strengthen, moving away from its weakest levels against the US dollar. This improvement is a welcome development, and it suggests that some pressures might be easing. It also reflects the impact of coordinated actions taken. While the journey to full recovery is ongoing, these initial green shoots are encouraging. They provide a sense of cautious optimism for the future. A key factor behind this nascent recovery is returning investor confidence. We are observing increased foreign direct investment into Malaysia. New projects are being announced, and existing investors are expanding their operations. This signals belief in Malaysia's long-term economic prospects. Portfolio inflows into our bond and equity markets have also shown improvement. These inflows increase the demand for ringgit, and they show that global investors are once again seeing value in Malaysian assets. This renewed interest is crucial for sustained currency strength. Specific government actions and policy clarity have helped. Clear communication from Bank Negara Malaysia has reassured markets, and the government's commitment to fiscal consolidation is also viewed positively. Measures to enhance governance and transparency contribute to a better investment climate. When investors perceive lower risk and greater policy predictability, they are more willing to invest. The government's emphasis on attracting high-quality investments in strategic sectors also helps. These include areas like renewable energy, the digital economy, and advanced manufacturing. Malaysia possesses inherent strengths that support its economic resilience. Our economy is quite diversified. We are not solely reliant on one or two sectors. We have strong manufacturing capabilities, particularly in electronics, and our commodity sector, including palm oil and natural gas, remains important. We have a growing services sector as well. Furthermore, there is a push towards innovation and higher value-added activities. These fundamental strengths provide a solid base, and they can help Malaysia navigate global uncertainties. They also underpin the potential for the ringgit's continued recovery. There are valid reasons for optimism regarding the ringgit's future. The proactive stance of Bank Negara Malaysia is a key factor, and its continued efforts to manage volatility are important. The government's commitment to structural reforms is also positive, as these reforms aim to improve economic efficiency and competitiveness. Strategic investments in new growth areas can create future income streams. If these efforts continue and bear fruit, they will strengthen the economy's fundamentals. A stronger economy naturally supports a stronger currency over the long term. However, significant challenges and risks remain on the horizon. Global economic conditions are still uncertain. The direction of U.S. interest rates continues to be a major influence. If U.S. rates stay high for longer, it could maintain pressure on emerging market currencies. China's economic slowdown is another concern. Since China is a major trading partner for Malaysia, slower growth in China can impact our exports and commodity prices. Geopolitical tensions in various parts of the world also add to global uncertainty. These external factors can swiftly change market sentiment. Domestically, Malaysia also faces its own set of risks. Political stability is always crucial for investor confidence. Any perception of instability can lead to capital outflows. The government needs to continue its path of fiscal discipline. Managing government debt effectively is important for long-term financial health. Continued implementation of necessary, sometimes difficult, economic reforms is key. These reforms might involve subsidy rationalization or tax system improvements, and they require political will and public support to succeed. In conclusion, the Malaysian ringgit appears to be on a path of gradual recovery. There are reasons for this hopeful outlook, including concerted policy actions and Malaysia's underlying economic strengths. However, the journey is not without potential obstacles. The global environment remains complex and unpredictable, and domestic challenges also need careful management. The sustained strengthening of the ringgit will depend on navigating these external headwinds effectively. It will also require unwavering commitment to sound economic policies and reforms at home. Vigilance and adaptability will be essential.